If you're an analyst, you know that financial statements are your bread and butter. But that bottom line profit figure? Yeah, it isn't always what it seems. In this explainer, we're going to look past the reported numbers to uncover a company's true financial health using a crucial CFA concept, quality of earnings. So let's just start with the most important question for any of us. How much can you really trust a company's reported profit? Is that number a solid foundation for your valuation, or is it maybe built on something a little less concrete? The real challenge here comes from accrual accounting. It can create this gap. On one hand, you have reported earnings, which can honestly be a bit of a mirage thanks to estimates and accruals. But on the other hand, you have the economic reality, the cold, hard cash. And that gap can make a company look way more profitable than its cash flow actually supports. So let's pull back the curtain on this whole earnings mirage idea. Because understanding why net income can be so deceiving, well, that's really the first step to becoming a much sharper, more effective analyst. This is exactly where quality of earnings, or QOE analysis, comes into play. You should think of it as a critical filter. It's the whole process of figuring out how reliable, how repeatable, and how cash-backed a company's profits really are. It's how we separate sustainable economic performance from, some temporary accounting artistry. All right, so where do we even begin? There's a really simple but incredibly powerful principle for QOE analysis. Let's call it the golden rule that just cuts through all the accounting noise. This quote just gets right to the heart of it, doesn't it? Net income grabs all the headlines, for sure. But the cash flow statement, that's where you find the hard evidence. And why is that? It's simple. Cash doesn't lie. It's the lifeblood of any business, and it is so much harder to manipulate than accrual-based earnings. So the most direct way to apply this rule is with a quality of earnings ratio. I'm telling you, this single number can sometimes tell you more than a 50-page annual report. And it's a super simple calculation that gives you an immediate signal. You just take the cash flow from operations and divide it by the net income. That's it. What you really want to see is a ratio that's consistently above 1. That's the ideal scenario. It tells you the company is actually generating more cash than it's reporting as profit. It suggests some conservative accounting and that those earnings are highly sustainable. It's a great sign. But a ratio below 1, that is a major red flag. It's telling you the company is not converting its reported profits into actual cash. Now, this could be because of aggressive revenue recognition, maybe a buildup in unsold inventory, or even problems collecting cash from customers. Whatever it is, it means you need to dig a whole lot deeper. Okay, so let's build on that ratio and look at a more complete analytical toolkit you can use to really systematically assess a company's earnings quality. A really solid COE check involves these 4 key steps. You start with a ratio, obviously, the one we just talked about. But then you've got to look at the trend over multiple years. Is that ratio getting better or worse? Next, you need to normalize the earnings by stripping out any one-time or non-recurring items. And finally, you have to dig into the details of working capital to see exactly where that cash is getting tied up. While you're doing your analysis, keep a sharp eye out for these specific cash flow red flags. For example, that widening gap between net income and cash flow, that is a classic sign of trouble. If a company can't generate enough cash from its operations to fund its own investments and pay dividends, well, it's basically living on borrowed time. And look, this isn't just some textbook exercise. Let's talk about how QOE analysis really bridges theory and practice in the real world of high-stakes finance. Here's a fantastic way to think about it. A standard financial audit, that's kind of like looking through a window. It just checks if the numbers follow the rules, like GAAP. But a QOE report, that's like getting a guided tour. It digs into the why behind the numbers to figure out a company's true, sustainable earning power. And nowhere is this more critical than in mergers and acquisitions. I mean, before anyone acquires a company, the buyer is absolutely going to commission a detailed QE report. It's completely non-negotiable. This whole process makes sure they understand the sustainable cash flow that they are actually buying, and it helps them avoid drastically overpaying for a business whose profits aren't nearly as solid as they look on paper. Okay, for all you CFA candidates out there, let's connect this directly to what you need to know for the exam, because this concept shows up across all 3 levels in one way or another. On the exam, you're definitely going to see scenarios testing these key ideas. Be ready to interpret a situation where net income is higher than operating cash flow. That's a clear warning sign. Remember that for a mature, stable company, you expect that high-quality cash flow to be positive and enough to cover investments and dividends. And critically, you'll be expected to normalize earnings, to identify and exclude those one-time items like a gain from an asset sale to get to the company's true recurring profitability. So ultimately, QOE analysis is what empowers you to answer this vital question. Are you looking at an earnings mirage, or are you looking at a cash-backed reality? It's all about moving beyond the headlines to understand the true financial health of a business. Mastering this isn't just going to help you on the CFA exam, it's going to help you spot value traps and find genuinely healthy companies throughout your entire career. This is not financial advice.